Welcome to 3 Points TV with Tom Lee. May's been a tough month so far. The S&P 500 is down 3% from its April highs, and clients have cited several reasons why they're increasingly nervous. One is the Brexit vote in June, and the other is that the Fed's coming back into the picture. With economic fundamentals holding up fairly well, there's concerns that we're going to see a June rate hike, and as you know, investors don't like volatility. However, we think the two key storylines that have driven relative performance year to date remain intact. Now, for our clients, the two that we've really been working with have been the idea that the US dollar is going to underperform consensus expectations. In others, be prepared for weak dollar trades. And the second is that the global search for carry is driving very good conditions in credit markets that is beneficial to equities. Now, you can see how these two trades collectively are driving some shifts in leadership this year that have caught a lot of investors off guard. Now, over the past 6 months, there have really been four phases to the market. From November to January, the market was selling off pretty sharply. And then from the end of January to the middle of February, the market was bottoming. We had a really nice rally from February to April, and then we've had this consolidation over the last 4 or 5 weeks. What's notable is the relative outperformance of energy, basic materials, and industrials. These groups are heavily levered to a weakening dollar and to improving credit conditions, and these are normally not groups you'd expect to outperform if the market is either consolidating or selling off or rallying. Yet over the last 3 of the 4 phases we're highlighting, these groups have outperformed. Now, we don't think this outperformance is a fluke. I think it's grounded in both a credit story and an earnings revision story. Take a look at this chart. This is the relative performance of the credit default swaps of these 3 sectors compared to their equity performance. And as you can see, the credit has vastly outperformed the equity in energy, basic materials, and to an extent in the industrial sector. In fact, basic materials CDS is back to 2012 levels, while the stocks are still close to their 2015 lows. The bottom line here is, as we believe credit obviously leads equities, this is arguing for a catch-up trade in the stocks. Now, the other part of this is really the earnings revision story. We've started to see positive earnings revisions for the industrials, driven by commodities bottoming, which are the end markets, plus a weaker dollar, in basic materials and energy, which are really driven by an improved commodity picture. But stop and think about that for a moment. We've got a credit story that's positive and positive earnings revision. These are really ingredients for continued outperformance of the stocks. But you might ask yourselves, well, maybe the earnings have already caught up to the improvement in commodities. We don't believe this is the case. For instance, take a look at the oil futures market, or what the oil derivatives market is pricing in for oil. This is what the market was looking for in December, and roughly $40 for the full year. Now, this is the current expectations in May. Oil has moved up roughly $7 to $9 across the strip. On an average, it's around $49 to $50 of oil. Now, how does this affect earnings? Well, in December, analysts were looking for $40 oil, and they made their forecasts. For the 6 integrateds, that increase in oil since December represents about $25 billion of incremental net income, or $2.60 per share. But that's assuming oil just holds at these levels into year end. What if oil prices actually increase from here? Well, that's something to keep in mind. Let's say, for instance, oil manages to get to $60, which is where it was about a year ago. Well, at $60, these 6 integrateds, because they've cut costs, could realize about $74 billion of incremental net income from current forecasts, and that would be over $7 per incremental S&P share. In other words, this improvement in commodity prices is not fully reflected in the earnings estimates for those groups. So the bottom line is, we still see the ingredients for the markets to strengthen into year-end. We think it's really grounded in a credit story. The flat to weaker dollar is positive for earnings, and we see it especially in the opportunity in these 3 sectors. Thanks for listening. This is Tom Lee with 3 Points TV.